Okay, so let's go ahead and let's look at these questions from the Chapter 10 quiz, okay? And a bondholder that owns $1,000, I'll tell you what, rather than have to sit here like a drunken sailor leaning on this thing, I'm going to go ahead and sit down, and then I get a better proximity to the microphone, if you don't mind. Okay. You can hear me all right? Okay. Bondholder that owns $1,000, 10%, 10-year bond has what? Has the right to receive $1,000 at maturity? We always get that face amount back, don't we? Okay. Okay, good. The party that has the right to exercise a call option is the issuer, right? They'll probably call it because interest rates have gone, what? Gone down? They want to refinance that? Number 3, the bond underwriter. That's the wrong answer to the previous question. A company's total liabilities divided by total stockholders' equity. I didn't go through that last slide, guys, when we came into the quiz, because I decided I'm just going to teach you to you from here. I hear it's the easiest thing in the world. Debt to equity ratio means that you put the debt in the numerator, your equity in the denominator. That's called the debt to equity ratio. Can there be anything easier? Debt in the numerator, equity in the denominator, debt to equity ratio. Okay. Now you look at this particular question, and they tell you that Charger Company has on its balance sheet assets of $27 million, liabilities of $15 million, and equity of $12 million. Can you set up the debt to equity ratio? $15 million divided by what? $12 million. Right? Now this is the kind of thing, guys, does this give you the right answer? Okay, now this is the kind of thing that, you know, students get mad at me on the exam. When I give you the exam and I don't tell you what the equity is, and they say, man, you really gave us different questions. Well, look, my expectation is that you should know to be able to take $27 million and do what? Subtract the liabilities, and that gives you the equity? I mean, that's about as weird as I get on these exams, where maybe I won't give you the equity and you have to calculate it, right? Okay, all right, good. Number 4, bonds sell at a discount when the contract rate of, say, what, 10% is below the market rate of, say, what, 12%? Is that what happened? Okay, good. Number 5, amortizing a bond discount allocates a portion of the total discount to interest expense each period, right? You take the $50,000, that didn't change in our little example. $50,000, and we took $73,605, which was the discount. We divided it by 10, and we added that to the interest, cash interest every 6 months, didn't we? To get the $57,360.50. So is it true that we allocate a portion of the discount to interest expense each period by amortizing the discount? The discount on bond payable is a contra liability. Contra means against. A discount on bond payable occurs when the company issues bonds with a contract rate of interest of, say, 10% that is less than the market rate of interest of, say, 12%. Alexis? You know, it's probably more complicated than what I'm going to describe, I'm sure. But it's, you know, what similar bonds of similar risk are trading for. Okay, and so they come up with this market rate of interest that they use to do this accounting. You know, it's not like God comes down and says, here's the market rate. The accountant will do his best, work with the underwriter, etc., to figure out what the market rate is, and then they just use it. It's not perfect, but remember we said that our accounting financial statements are full of estimates, right? So it's an estimate of what similar debt would be trading for. And again, I'm sure, there's probably some underwriter somewhere right now plugging their ears going, oh my God, that's not what we do at all. Okay, but it's something, in that ballpark. Okay, number, what would have been number 8, 7A here. When a bond sells at a premium, the contract rate of what? 10%. Is above the market rate of, say, in our little example, 8%, right? Okay, good. Number 8. Okay, and here's, you'll see a few little questions like that on the final, but this is more the type you're going to see, okay, where I'm going to make you do the accounting for it. So January 1st, company issued and sold $400,000, 7%, 10-year bond payable, and received proceeds of $396,000. Is this a discount bond or a premium bond? Huh? Discount. It's what? It was a $400,000, 7%, 10-year bond. That's all what's on the face of the bond, right? Right? And we received proceeds of $396,000. We got less cash. That bond issued for less than face, didn't it? So it's a discount. Okay. Now it says interest is payable June 30th and December 31st. Thank you. Semi-annual bond. And we're going to use straight line to amortize the discount, which is the only method we'll use in this class. Okay, and so what happens? We figure out the cash interest is $400,000 times 0.07, and it's times 1/2 because it's a semi-annual bond, isn't it? So this is like your buddy $50,000, but now it's $14,000. That's going to be paid out every 6 months. Okay, so we know right out of the gate that we're going to credit cash for $14,000. Now the test wasn't that nice to us, and then they gave us a few options in which there's credit to cash at $14,000. So we still have some way to go to see what the answer to this is, right? Okay. Now what happens? We're going to amortize the discount. The discount is $400,000 minus $396,000. Gives me a $4,000 discount if I'm doing my math right. And I divide that by what? Good. Number of years times 2 because it's a semi-annual bond, right? And so the term of the bond was what? 10 years? Times 2 is 20. So that gives me what? $200 every 6 months? And that $200 of discount amortization adds to my interest expense, doesn't it? You wrote that down? Okay. So the $14,000 plus the $200 gives me $14,200 interest expense. I credit cash for what? 14, and I credit the discount now, don't I, to bring the discount down? I erased it now. To bring the discount down, we have to credit it, right? The amortization makes it less, so I have to credit it. Okay? Okay, good. Stop me if you got a question. Number 8, number 9, whatever. A company issued 10% 7-year bond with a par value of $100,000. The company received $96,526. Discount bond or premium bond? Discount bond. Good. I'm going to take the $100,000. I'm going to subtract off the $96,526, right? That gives me discount calculators. $3,474, like that. Okay. I take that $3,474, and they want the interest expense for the first semi-annual period. So 3,474 is going to be divided by what? 10 years. If it's a semi-annual bond, what do I have to divide this by? Huh? What do I have to divide this by? Divided by 10 times 2, or 20, right? Okay, so 3474 divided by 20 equals 173.7, you say? Okay. Now, that's the amount of premium discount amortization, isn't it? That's going to add to my cash interest. So I got to figure out the cash interest. How do I do that? $100,000 face of the bond times 0.07 times semi-annual bond. Have to multiply that times 1/2. 3,500. Good. And I take that 3,500 and I do what? Add the amount of discount amortization, don't I? And when I do, I get this what? $3,673.70. That 70 cents had me concerned, but sure enough, there it was, 70 cents. When you told me that 70 cents, I'm like, huh? Okay. Okay? All right, good. Let's look at another one. The market value price of a bond is equal to the present value of all future payments. We took the present value of the interest, the present value of the principal, didn't we? Those are the future cash flows that have come from that. Okay. Company received bond proceeds of cash proceeds of $206,948 on a bond issue with a par value of $200,000. The difference between the par value and the price of the bond is recorded as a, let's do the whole journal entry. When you issue the bond, what do you debit? Huh? Well, I asked what you debit. Huh? You debit cash. You're receiving cash. You're borrowing money, aren't you? $206,948. Right? Okay, what do you want to credit here? Good. Credit bond payable for the full $200,000, right? What else do you want to credit? Good. I'm going to credit the premium for the 6,000, what is it, 6,948? Right? I'm borrowing money. I'm debiting cash, right? I always set up the bond payable at face. If I get more cash in the face, I credit the premium. If I get less cash in the face, I debit the discount, right? To make the journal entry balance. Company issues 7% bond with a par value of $100,000. The market value when the bonds were issued was 6.5%. Is this bond going to issue? Oh, they didn't make that very hard. I was going to ask you if it issued a premium or a discount. Obviously, it issues at what? A premium, because the stated rate was more than the market rate, right? Okay. Using the straight line method, the amount of interest expense for the first semi-annual interest period. And guys, what I would suggest you start doing in these questions is just get that cash out of the way. The cash calculation, it's easy, just get it out of the way. It's 100,000 times what? Times 0.07 times what? Times 1/2, that's $3,500 every 6 months. Just get that out of the way. Then sit there and look at it. Was it a premium or was it a discount? This was a premium, so I take the 2,105 and I go ahead and I divide that by, and they tell me this is a semi-annual bond. So, and it was a what, 5-year bond, so I'm going to divide that by 10. That gives me $210.50. So I simply add that. Premium bond, I do what with it? Premium bond, I subtract it, right? right, below the cash interest. And when I do that subtraction, I should get this answer here of 3,289.50.